Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And it is just me today, Miles here. Tori is out of town, Rob's out of the office, and I'm going to be sitting here solo today. So I'm going to try to channel my inner Rob and inner Tori, as well as look at a couple short-term charts here and what we've seen happening in the metals market. But I think after listening to Kevin and David on the weekly commentary yesterday, which aired this morning, and then, of course, reading through Morgan Lewis, who writes our weekly Hard Asset Insights, which you can find on McIlvaney.com as well. And then years and years of Tori wearing me down. As we're coming out of the summer doldrums, moving into fall, we've got some potential interest rate rises pending either this month or next. And given the types of phone calls that we're getting from clients here all summer long and the concerns we're seeing, everybody knows what gold has been doing the last couple weeks, and we're moving towards fall. And I just can't keep saying the same thing about the charts over and over again. We're in a trading range. We're waiting for breakout one way or the other, moving on. But what we can keep talking about is what are we moving on into? So I started thinking about what are some of the questions that I've been consistently asked this year. You know, we're coming off of COVID. We're coming off of Russia and Ukraine. We had one of the largest banks in the world fail earlier this year, Silicon Valley Bank, followed by a few others. And I realized that the biggest question we've been getting all year is my bank safe? You know, and that's something that I know David talked with Curtis Bowers on Curtis's podcast here recently. That's something that we've had a lot of clients asking about. Why are so many banks getting downgraded? What are some of the causes for that? So I started looking through some of these points, and I thought it'd be worth for our listener to go through a couple things one by one and help you answer the question of when is gold finally going to make that move? So why have so many banks been downgraded this year? Thus far, I've come up with two conclusions. First one is, frankly, why in the world would you keep large dollar deposits at a bank when you can just go buy treasury bills? With the interest rate rising and Powell's commitment, well, it's a verbal commitment, but with Powell's commitment going forward with where interest rates are going to continue to rise to, why in the world would you be sitting in bank CDs or large dollar deposits in FDIC-insured savings accounts paying you almost nothing, especially on the heels of Silicon Valley Bank declining? So first and foremost, when I'm doing bank ratings for clients, I'm amazed at the size of the liquidity position, or at least lack thereof. Second issue that I'm seeing is the significant amount of money that banks are lending for the consumer loan category. You know, one of the big concerns with consumer loan is a lot of times you're talking credit cards. That's variable rates of interest. So I went and did a little digging. So consumer lending for all commercial banks is up 23% since April of 2021. So a significant increase in revolving lines of credit that the average U.S. citizen is taking out of their banks. And as interest rates are beginning to rise, it's getting harder and harder for them to make those payoffs. Looking at things like non-performing loan categories, you know, loans that are 90 days past due or worse that just haven't been charged off yet. And then comparing that to if they default, what kind of damage is that going to do to the capital of the bank? Capital that they don't have right now in liquid assets, because all that money's gone over to Schwab and Fidelity and TD Ameritrade into their money market positions in treasury bills. So there is a significant potential banking crisis looming here that I think the average American needs to be aware of, and you need to be looking at the safety of your bank. So we take a step out from banking and we look at, okay, well, how's that affecting the markets as a whole, the liquidity crunch? Well, I brought up last week a good old tenet of Dow theory, the transportation average, and the expectation that the transportation average leads out the Dow Industrials, the stock market as a whole. If you're not shipping goods, you're not selling goods. Well, the transportation average did fail to put in a higher high and has been pretty significantly down here over the last few weeks. Now, the Dow Industrials does look like it might take another step up, but if it also fails to put in a higher high, and we see the transports continue to decline, well, there's the top of your market right there. Real estate's the same way. The real estate select sector index is down 31% in less than 2 years since December 2021. So the equities market, while nearing highs, is showing significant weakness. Real estate market has already turned down. Your cost of living expenses certainly haven't, because the average cost of living expense is up. I mean, oil is up. WTI crude up 32% just since this July. Brent crude up 29%. So the cost of living is increasing while the investment gain potential on the other side in two of the biggest markets that the average American invests in, real estate and the equities market, are both either topping or already showing decline. So that started me thinking here recently, okay, what can we take a swing at? And I was listening to some interviews this weekend, and a Warren Buffett interview from a number of years ago came on, and I was kind of listening to a few minutes of that. And I thought he brought up an interesting point. He made an analogy to baseball when it comes to investing, and I love baseball, for anyone who knows me. When you get up to bat in a batter's box, you got three pitches, three good pitches that you don't swing at and you're out. And he brought up the point that when you're an investor, you can watch thousands of pitches go by. You don't have to swing. Just because it looks real good doesn't mean it's your pitch. And you ain't going to get out by watching it go by. You can watch hundreds, thousands, tens of thousands of pitches go by, waiting for that perfect one. That what's Buffett's biggest argument for years: invest where you have an advantage. Invest where you know what you're investing in. So while you're waiting for your perfect pitch to come by, you can wait for that thing that you understand, you know, and you can get invested in. So there is no real reason to be taking swings at markets at the top end when you're looking at banking issues, international concerns, which we'll look at here in a second, and then additional economic problems here domestically. You don't have to swing at the pitch. And I think that the average American is kind of looking at that. Again, getting back to people dumping money into the treasury bills. So one thing David and Kevin brought up on their show yesterday was the Buffett indicator. The Buffett indicator is the total market capitalization divided by GDP. For those of you that caught the show yesterday and might have missed the specifics on that, the argument is, and they use the Wilshire 5000 generally, they look at the total value of the stock market, which right now is sitting at 49 trillion. And they divide that by GDP, which is around 27, 28. So if you do that calculation, it's about 175%. So I went back and looked and said, okay, what are some of the thresholds for that? Well, we hit 2-to-1, where the capitalization of the market was twice that of GDP. We hit that in 1968. Lo and behold, we saw a lengthy decline in that ratio for about 10 years. We hit it again in 2000, and we saw a lengthy decline for about 10 years. Well, we just hit it again in 2021, and that's why they're talking about it. Now, what happened during that period? Well, between 1968 and the mid-70s, a lot happened. You had massive volatility in the markets. You had civil unrest. You had international issues with the Cold War with Russia. There were significant problems globally, not just here domestically, not just economically, in the late 60s, early 70s. What happened in the 2000s? Well, what kicked it off? The tech stock bubble and burst. You had an over 30% decline in the markets in 2000. And it ended that 10-year period in one of the biggest market declines we've ever seen, 55% down in the Dow in 2007. Well, we just saw it happen again in 2021. So I don't know if I'm calling necessarily for a 10-year cycle where you're going to see this start to transition back the other way, and probably some periods of significant volatility. But I do think a lot of these other things are going to add on to that, like we talked about with banking, like we looked at with markets and investment opportunities. Recently, St. Louis Fed anticipates third quarter GDP negative 0.7%. So they're expecting decline in GDP. Student loan interest back on the table in October. 43 million Americans will be affected by that as interest starts calculating and adding up starting again in October. That's a significant percentage of the population that is going to have interest-bearing payoffs once again that they've gotten a little break from for the last couple of years. Bureau of Labor Statistics revised job openings down again significantly this quarter. And guess what? Every single non-farm payroll and every single monthly release for single-family home sales also been downgraded this year. We are unquestionably in a recession with banking crisis, currency crisis, economic instability, and stock market nearing and probably turning down. Internationally, what are we seeing? We're not seeing gold rising here in the U.S., but we are seeing the dollar index start to climb again. Sure, it bottomed out, and we've been talking about that the last couple weeks. But we are seeing the dollar start to climb again. The dollar hits all-time highs against the yuan and renminbi as long as you ignore the period back when the yuan was pegged to the dollar, which ended in '05. So the dollar's the strongest it's ever been against China since that occurred. But gold hit new all-time highs in the yuan. I know Kevin and David brought that up on the show yesterday. I think that's worth pointing out again. But here's something they brought up that I had to go look at a chart. Gold up against the Japanese yen. Now that chart looks a little bit different, you can see here, because where gold versus China, we just broke into new highs. You look at what's taking place in Japan, gold's up 123% since 2019 in the yen. So internationally, you're seeing significant issues across the board as well. And the rising interest rate, while it is causing us to suffer here domestically, is offering a little bit of respite for international investors looking to move out of their own currencies and into treasury bills if possible. So what does this all mean? To me, what this all means is, for those of us that are curious, especially me, being that I get to sit here without Tori giving me that I told you so look that he would be giving me right now. Without Tori sitting here giving me the I told you so look, sometimes those of us that like to look at the weekly and monthly and daily chart moves and try to get a feel for how the market's reacting to certain events and Fed announcements and interest rate moves, sometimes you have to take a step back and you have to look at the whole forest. And I guess as we're moving out of the summer doldrums into the fall, we're getting our kids back in school, we're getting ready for a holiday season, we're getting ready for a massive election year next year. As we're starting to look forward into the things that are coming, I'd highly encourage everybody from an economic standpoint, let's take a step or two backwards and let's look at the whole picture here. We've got banking issues, we've got economic problems, we've got social distress, we've got international war, we've got Middle East issues, we've got Russia and Saudi Arabia tightening the oil spigots, and we've got oil increasing. We've got a lot of things that we need to be prepared for. And while we have an opportunity to, as markets cycle, pick up some additional ounces of things like precious metals, that at all times, an ounce of gold buys you 350 loaves of bread. It doesn't matter if that loaf of bread is 50 cents or $50. That ounce of gold is going to be there to exchange real goods and services for a real asset, not an inflated asset where we're solving our problems through debt and leverage. So I'd encourage you to give us a buzz this week, moving into this fall, before we get sidetracked by everything going on, and before we move into our seasonal period where the metals begin to climb again and we're looking at the next stair step up. Give us a buzz at 800-525-9556. We'd love to talk with you about your personal portfolio in precious metals. We can also be found on Twitter at ICA Gold or Facebook at McElvaney Financial. And if you'd like to learn more about the company, catch any of the articles, podcasts, our show, anything else that we put out on a weekly basis, you can find that over on our website at McElvaney.com. Thanks again for listening. We'll come back with a normal show next week. Hopefully have the guys back in the office, and appreciate you joining me this week.